Welcome back to the Daily Nugget. Daily property insights, one topic, 20 minutes or less, 7 days a week. Myself, Lawrence Lotze, and today joined by Matt Harris, a property tax specialist and a fellow property investor. And Matt, the question to you today is insurance. From investing point of view, what should I think about it? What should I look into it? And it's something that people think it's quite simple just to do one insurance for all those options. Let's have a chat about it.
Yeah, I think it's a good topic to chat about today, Lawrence. Insurance is one of those things that we all love to hate.
Mhm.
And I liken it to taking an umbrella with you when you leave the car. You can guarantee it won't rain if you do. And if you leave it behind, it will. And I think that insurance is pretty much the same kind of universal concept. If you get insurance, pretty much you can guarantee you'll never need it. If you
Mhm.
don't get insurance, then probably something's going to happen and you will need it. And that's just the way the world works. So when I look at it in the context of property investment, and I think about property investment as a discipline, it is, if you're a buy and hold investor, which is most investors that we deal with, and the majority of investors in New Zealand, you effectively building a passive income stream over time. And it's relatively low risk in terms of the fact that you have a bricks and mortar asset.
Mhm.
Not much can happen to that generally. You have a rental income stream, and all things being equal, both those things will continue as long as the house is standing.
Yep.
So, where insurance comes into play is that the biggest risk to a property investor is generally in their personal life,
Mhm.
loss of earnings, health, death.
Mhm.
Especially negatively geared investors. So that's an investor that has to top up the mortgage weekly or fortnightly. The economic shock that occurs generally doesn't occur in the property portfolio, it occurs in the personal side.
Mhm.
So when I look at it, I go, well, actually, if that's the only risk, really, really easy to deal with that risk with insurance. So
Mhm.
the common types of insurance that we would encourage property investors to have a look at would be loss of earnings insurance, and
Yep.
really important if you've got a mum and dad investor. And I've used this
Mhm.
term a bit on your show, and I don't just mean parents who own properties. It's just a way of saying, a working couple
Mhm.
who have between 1 and 5 investment properties.
Yep.
You might have a really high earner, and then you might have a stay-at-home parent,
Mhm.
and maybe they work part-time, but they're the low earner. If something happens to the high earner's income or their house, so they can't get that income, then the economic shock that goes through that household can be quite large. So if you
Yep.
insure against those incomes and or health and or death, then you
Mhm.
effectively mitigate risk. So it's one of those necessary evils. And I think if you're treating property investment like a business, which I always
Yep.
encourage people to do, most people wouldn't be in business without some sort of insurance, and a property investor is exactly the same.
So true. I mean, I put my hand up from experience. Anyone that knows my backstory and what happened to me a couple of years ago with my brain tumor, my insurance didn't pay out. My insurance didn't protect me for what I thought. So I had the right step of actually having insurance to protect
Mm,
me, and it then didn't protect me. And I ended up in a situation where I bounced on a mortgage. I got into a situation that I had to sell everything I had because what I thought was my protection the right way didn't do it, and then put myself into that critical situation. And with Matt saying is get the protection for yourself, for your family, for the worst case scenarios. So just in case something does happen, it does pay out. But also take it from my experience. Don't just call up, and I'm going to just say this generally, so don't hate me, banks. Don't just call up your bank and go, "Hey, bank, can I have normal insurance?" I did this 10 years ago, and that's where I stumbled. Phone the right people, find the specialist, speak to the people in your circle, or even reach out to myself or Matt, and we can guide you to the right people to use depending on what insurance you're looking for, so they know the right questions, because insurance companies make money by not paying out insurance. They
correct. And I
make it
think
by getting they get it from the premiums, not and finding the fine print that doesn't mean the payout. So you need to get the right broker around insurance that knows to find the right deal for you.
you've said it perfectly. Uh, a bank's job, in my mind, is to give money
Hmm.
to allow a property investor to build a portfolio, a business to fund an
Yep.
expansion. Their core business is not insurance. Where
Mm.
possible, you should avoid taking insurance in the bank, and you're not the
Yep.
only person who's had an experience like that.
Hmm.
And and I think it's pretty telling out in the market that most banks are offloading their financial advice and insurance businesses anyway at the moment.
Yep.
So we would always encourage that you work with a financial advisor. We have them in our office. Obviously, lots of other financial advisors around, they will put together a fit for purpose insurance package that will cover you. So I guess the only other thing to mention, and on the insurance thing before we end this up, is that there are other types of insurance that are applicable to investors, and that's obviously loss of rents insurance. And I think if you look at the wider picture, obviously the level of house insurance that you get as an investor is really important. And I don't want to blow this out into a really big episode, so I'll just say it quickly. The insurance companies after the Christchurch earthquakes have moved to a system where you have to estimate the rebuild value of your property. So you only insure the capital amount of your property. You do not insure the land, and that's on the basis that the land should still be there. If it's not, people like the EQC Commission, for example, would pay for the land anyway. I think probably in New Zealand, over 50% of people would be underinsured, especially with the recent price rises. But you can't build a house now. You can buy a house cheaper than you can build a house now. So that's an indication that most people should be going out and looking at their policies and probably upping them the rebuild cost $200,000 or $300,000. So I think probably an important thing to have a look at if you're an investor.
Yeah, totally agree. And thanks so much for that, Matt. As always, to anyone else that's listening on the episode or watching, has any questions for myself or Matt, the details will be in the description. And thank you for coming over to Daily Nugget, Daily Property Insights, one topic, 20 minutes or less, 7 days a week. And as always,